Purpose. The purpose of the Fixed Asset Management Standard Operating Procedure is to outline the procedures for effective management and accounting of fixed assets throughout their lifecycle, from acquisition to disposal. Scope. This standard operating procedure defines the procedures, including the responsibilities, internal controls, and authorizations for the management of all fixed assets owned and operated by ARENA Middle East and Asia. Applicability. The procedures defined in this document are aimed at the asset management team, who are responsible for ensuring that ARENA's fixed assets are monitored, managed, and maintained to provide the best possible service to users delivering ARENA's Middle East and Asia operations. Capital budgeting. A formal plan for making investments in property, plant, equipment, or other infrastructural development. Items included in the capital budget have lives exceeding 1 year and often require long-range planning. Capital expenditure, or CAPEX, is the purchase of or outlay for an asset with a life of more than 1 year, or that increases the capacity or efficiency of an asset or extends its useful life. Such expenditures are generally depreciated or amortized over the respective useful lives of the relevant assets. Controllable assets. Assets that do not meet the criteria for fixed assets, typically due to a historical cost of less than 4,000 riyals, dirham, or ringgits. Controllable assets are maintained solely for tracking purposes and are not included as depreciable assets in the comprehensive annual financial report. Cost model. After an item's recognition as an asset, it is carried at its cost, less any accumulated depreciation and any accumulated impairment losses. Depreciable amount. The cost of an asset, or other amount substituted for cost, minus its estimated residual value. Depreciation. The systematic allocation of an asset's depreciable amount over its useful life. Disposal. The sale, demolition, gifting, or recycling of assets owned by ARENA, or the disposal of assets declared surplus to ARENA's requirements. Fair market value. The price agreed upon in an open and unrestricted market between knowledgeable and willing parties acting at arm's length, fully informed, and not compelled to transact. Fixed asset. An asset with a useful life exceeding 1 year and a historical cost of 4,000 or more dirhams, riyals, or ringgit. Residual value. The estimated amount that ARENA would currently receive from disposing of the asset, after deducting estimated disposal costs, assuming the asset is of the age and condition anticipated at the end of its useful life. Revaluation model. Following initial recognition, an item of property, plant, and equipment with a reliably measurable fair value should be carried at a revalued amount. This amount reflects the asset's fair value at the date of revaluation, less any subsequent accumulated depreciation and impairment losses. Re-evaluations must be conducted regularly to ensure the carrying amount closely aligns with fair value as of the reporting date. Useful life. The period during which an asset is expected to be available for use by ARENA, or to provide anticipated economic benefits. Write-off. The process of removing or derecognizing an asset from ARENA's asset register and financial statements at a nil value. Procedure. The Fixed Asset Management Procedure comprises 7 key activities, as outlined in the image. Each activity is detailed in the following sections to provide a comprehensive understanding of the processes involved in effective fixed asset management. The asset manager is responsible for setting criteria for recognizing, capitalizing, and depreciating fixed assets, in line with accounting and management requirements. To qualify for capitalization and subsequent depreciation, assets are identified according to asset identification criteria and capitalization thresholds. In accordance with IAS 16's guidelines for property, plant, and equipment, ARENA defines fixed assets as tangible items that meet the following conditions. They are held by ARENA for use in the production or supply of goods or services, rental to others, or for administrative purposes, and they are expected to be used by ARENA over more than one financial period. Fixed assets are classified into 2 broad categories: rental assets and non-rental assets. Each category is further divided into specific asset classes and their corresponding base units. The determination of base units is based on the following criteria. The base unit is the smallest item that can be capitalized within an asset category. It is readily identifiable and distinguishable from other similar items. Its details can be conveniently and cost-effectively tracked. The base unit is composed of components that have equal useful lives. It is subject to periodic verification. Establish asset valuation criteria. RENA's current asset classification hierarchy is as listed in the table in an upcoming slide. All assets considered for capitalization must meet the capitalization thresholds in addition to the asset identification criteria. The thresholds represent the monetary value at which an asset is capitalized. Purchases less than the capitalization value threshold are treated as expenses in the current year. The asset capitalization threshold value is currently set at 4,000 riyals, dirham or ringgits. Expenditure may still be capitalized on items that are individually immaterial, but are significant when considered as a group of assets. In such cases, the threshold should be applied at the total project or whole asset level, rather than on an invoice-by-invoice basis. If treated singly, an asset may fall below the capitalization threshold. Cost of a fixed asset is recognized as comprising of its purchase price, including any import duties and non-refundable purchase taxes, after deducting trade discounts and rebates, any costs directly attributable to bringing the assets to the location and condition necessary for it to be capable of operating in the manner intended by management, the initial estimate of the costs of dismantling and removing the item and restoring the site on which it is located, the obligation for which an entity incurred either when the item is acquired or because of having used the item during a particular period for purposes other than to produce inventories during that period. Renovations or improvement costs are added to the value of the asset if the improvements fulfill at least one of the following criteria. The useful life of the asset is increased. The productive capacity of the asset is improved. Spare parts may be capitalized where they meet the capitalization threshold, and they are expected to be used over more than 1 year. Detailed guidelines for identification of specific capital costs for individual asset classes are provided in Appendix A, Fixed Asset Cost Recognition Guidelines. Except for land, all capitalized assets should be depreciated using the straight-line method over the useful life of the asset class. An asset's life is the period over which services are expected to be rendered by the asset. Depreciation of capitalized assets will commence in the month the item is placed into service or use, and continues until the asset is retired or disposed. The calculation of depreciation should be based on capitalized costs. The amount of annual depreciation is determined by dividing an asset's cost reduced by the salvage value, if any, by its estimated useful life. The total amount depreciated can never exceed the asset's historic cost less salvage value. At the end of the asset's estimated life, the salvage value will remain. After initial recognition, asset costs are measured using either a cost model or a revaluation model. The selected model should be applied across the entire class of assets and shall not differ among individual assets in a class. All fixed assets must be recorded in the Fixed Asset Register or FAR. The inventory controller is responsible for the inclusion, removal, maintenance, and or review of the FAR. The minimum information required in the FAR includes, but is not limited to, the unique asset identification number, asset description, classification, date of purchase, implementation period, cost of asset, location, organization, current condition, person responsible, estimated, useful life on the date of acquisition, warranty period, and contact information of the supplier. To facilitate the physical verification, each asset must be tagged with the unique asset identification number or code in line with the number or code in the FAR. The FAR must be kept up to date for all acquisitions, additions, disposals, theft, or other pertinent changes. The FAR must be inclusive of fixed assets purchased over multiple implementation periods and contain assets transferred from one entity to another. Assets can only be removed from the FAR when management, use, and/or control of that asset has changed, i.e. when the asset is transferred, damaged beyond use, stolen, or disposed of. Plan and acquire assets. Requests for the acquisition of fixed assets or capital expenditure requests fall into 2 categories: raised as unbudgeted capital expenditure requests and raised under budget capital expenditure. A capital expenditure request form, CRF, must be completed and submitted for review and approval for all capital expenditure requests. The asset manager, in collaboration with the requisitioning department or unit, initiates the CRF process. The asset manager will be the point of contact for the unit regarding any questions, issues, or reporting, such as project status or financial status, that the unit may have during the acquisition of the fixed asset. For capital expenditure requests related to furniture, fixtures, and equipment, the FF&E project coordinator can initiate the CRF process. For non-rental assets, the head of the department can initiate the request. All capital expenditure requests must be approved by the asset manager. For unbudgeted capital expenditure requests, the Capital Expenditure Request Form (CRF) should be accompanied by a business case that justifies the acquisition of the fixed asset. This business case may include cash flow forecasts, net present value, internal rate of return, and payback calculations, depending on the capital expenditure requirement. The asset manager, with support from the finance director, will assist the requisitioner in preparing the business case. Group senior leadership will set the guidelines for approving capital expenditure projects. For these requests to be eligible for approval, submissions must meet the minimum criteria set by management. Requests that do not meet the guidelines will not be approved unless the requisitioner can provide strong strategic value and justifications in the CRF or business case. Approval of the capital expenditure request will follow the guidelines outlined in ARENA's Delegation of Authority Matrix. Capital expenditure requests raised during the annual budget planning process must be clearly identified as capital expenditure. These requests are approved by Group FP&A as part of the annual budget approval. However, this approval does not authorize individual capital expenditure items. No capital expenditure commitments should be made until all requirements in this procedure are met. For capital expenditure requests needing Group FP&A approval, the regional CEO or finance director will submit the Capital Request Form (CRF) and supporting business case to Group FP&A and assist in validating project elements. Approved individual capital expenditure requests are identified as capital expenditure when raising a purchase requisition in the ERP. The procurement of capital expenditure assets must follow the procurement procedures. The purchase must be made with a purchase order via a requisition in ARENA's procurement system, ERP. The finance team will maintain a budget versus actual utilization tracker for capital expenditure, as well as a log of individual capital expenditure items procured under each project capital expenditure and annual budget. Operate and maintain assets. The asset manager is responsible for ensuring that all assets are used efficiently and effectively. The warehouse manager must be guided on efficient storage, maintenance, and operation of the assets stored in ARENA warehouse. Fixed assets should be used only for supporting ARENA's business purposes. Formal guidelines must be established for safe operation, maintenance, and monitoring of assets, defined based on the type and significance or criticality of the asset. Steps must be taken to safeguard assets through adequate all-risk property insurance, warranties, guarantees, annual maintenance contracts, or general liability insurance as applicable. For critical assets, a preventive maintenance plan must be established, considering cost-benefit analysis, supplier recommendations, risk of outage, qualified personnel, and other relevant factors. The asset manager is also responsible for ensuring that any assets procured are distributed to intended beneficiaries based on a needs assessment. The warehouse manager should process a request for distribution of rental assets only with an approved request from the account manager or project manager. Distributed assets must be accompanied by waybills, delivery notes, installation reports, or other relevant installation documentation as evidence of asset transfer. Any staff member using capital equipment should be competent in its use and have knowledge and experience of the equipment, along with awareness of any associated risks. The asset owner, or person responsible for the asset, should ensure that the user is provided with adequate training in the safe use of the asset. If a member of staff finds something wrong with the equipment, they should remove it from use immediately and report it to their line manager. For rental assets, the warehouse manager in charge of the asset is responsible for defining a maintenance plan and conducting the repair and maintenance of that rental asset item. For non-rental capital equipment, excluding IT, the office administrator is responsible for ensuring maintenance. For IT equipment, maintenance is ensured by the IT manager. For rental goods that are severely damaged, a damaged goods report, DGR, must be prepared. The damages are photographed, and the item is stored in a designated location for verification. The DGR, along with the photos, must be issued to the warehouse manager. The warehouse manager reviews and submits the damaged goods report, DGR, to the accounts manager and finance manager, who will recommend the allocation of the repair expenses. The warehouse manager requests the procurement manager to source repair services following Arena's procurement procedures. If external suppliers or service providers are needed for maintenance, the purchase of maintenance services must follow the procurement procedure. The office administrator or IT manager initiates purchase requests, which are then approved by the asset manager. Only approved service providers should be used for the maintenance of capital equipment. Monitor and optimize asset value. All fixed assets must be monitored through periodic verification of the existence of fixed assets with physical counts, review or assessment of the current condition and estimated remaining useful life of the fixed assets, reconciliation of physical verification results to the AR, and investigation and correction of any differences, including confirming the correct and current location, and verification of internal controls and checks to ensure appropriate use, maintenance, completeness, and accuracy of records. The asset manager must establish a risk-based mechanism for periodic physical count and verification. Assets recorded on the FAR that are stolen, misused, or otherwise unaccounted for must be immediately reported to the asset manager. The asset manager must take appropriate and proportionate measures to investigate the asset's misuse or disappearance, and to mitigate further losses of a similar nature. If an asset cannot be found, an investigation should be completed, and every attempt must be made to recover the asset. If unsuccessful, the loss of the asset should be reported to the finance director, and the asset will be removed from the FAR. On a regular basis, the asset manager reviews the maintenance costs, asset-related sourcing strategies, warranties, and replacement opportunities to identify value for money, lower-cost options. Manage asset transfers. The transfer of fixed assets is based on business requirements or the condition of the specific asset. Fixed assets are transferred to or from one of Arena's subsidiaries when there is a justified business need for the asset. Fixed assets are transferred through the submission of a fixed asset disposal or transfer form to the asset manager. The asset manager must conduct a physical verification of assets before initiating the transfer process. Assets are transferred either permanently or temporarily. Asset transfer forms should only be used when an asset is moving permanently from one location to another. For permanent transfers, a new asset owner should be assigned for the transferred asset. During temporary moves, lasting up to 3 months, the existing asset owner retains responsibility for the asset. The transfer of fixed assets must be accompanied by waybills, customs and clearance documentation, delivery notes, installation reports, or other relevant installation documentation. The logistics executive is responsible for preparing all required documentation and retaining these documents for future reference. To arrange transportation from third-party logistics providers, the logistics executive identifies and procures transportation services from an appropriate third-party logistics supplier following Arena's procurement procedure. The logistics executive coordinates with the asset manager and the warehouse manager to prepare all required shipping documents. Shipping instructions are forwarded to the delivery team leader and the warehouse manager to ensure that transportation is completed as planned. The fixed asset transfer form is submitted to the finance director for review and approval, following the guidelines in Arena's delegation of authority matrix. Once the asset is transferred permanently, the FAR must be updated accordingly. Dispose or write off assets. Fixed assets are retired or disposed of through sale to external parties or by being written off. An asset may be disposed of when it no longer meets technological requirements in terms of information technology hardware. It has been clearly established by the asset manager that there is no further business need for the item concerned. It no longer functions and repairs are not cost-effective, or it has been established that retaining legal title over items under custody is no longer in the best interests of Arena. Fixed assets may be disposed of through a sale at a value higher or lower than their net book value. Write-off of an asset occurs when it is removed from Arena's books because the asset no longer exists, the asset is no longer generating benefit to the company, or the asset's value is considered scrap or salvage. The most common indicators of a write-off include physical damage, evidence that the service performance of a fixed asset is or will be significantly worse than expected, technological obsolescence, internal decisions which negatively affect the use or useful life of a fixed asset, and a decline in usage. Fixed assets are to be disposed of through the submission of a fixed asset disposal or transfer form to the asset manager. The request must clearly include the following details: description of the asset to be written off or disposed, reason for write-off or disposal, financial year originally acquired, method of disposal such as sale, scrap, part exchange, or other, value received for a disposed asset, sales invoice number and asset ID, and documented details confirming that a physical inspection was performed to verify the condition of the assets. The asset manager must conduct a physical verification of assets before initiating the disposal process. For a recommendation to dispose of a fixed asset through a sale, 2 quotations must be obtained and submitted with the request for approval. Assets declared surplus must be disposed of by public tender, auction, or other means that ensure a transparent and competitive process. Assets are not typically disposed of to arena's staff unless a transparent and competitive process is followed and documented. The best possible value must be obtained from the disposal of assets. Asset disposals must be approved by the regional CEO finance director, and an assets disposal form must be completed. If IT equipment, such as a computer system, is disposed of, the IT team must ensure the equipment is properly data cleansed, including the removal of any software licenses, to prevent any information security risk. The disposal procedure must comply with all local and international HSEQ standards and directives. A justification should be provided for the disposal of a fixed asset if there is still a residual net book value for the asset. When an asset is disposed of through a sale to an external party, proceeds from the sale must be correctly and promptly recorded in arena's financial accounting systems. Once the asset is disposed of or retired through a sale or write-off, the FAR must be updated accordingly. RACI Matrix. A RACI matrix is a tool that clarifies roles and responsibilities in a project by designating who is responsible, accountable, consulted, and informed for each task. Please take some time to study this matrix for a clear understanding of team roles. Please review this RACI matrix carefully. Related documents and references. Here is a list of the documents referenced in this lesson.